Imagine a snowball rolling down a hill, growing larger and faster with every turn. That's the power of compounding assets at work. So, what exactly are compounding assets? These are investments that not only generate earnings, but also reinvest those earnings to generate their own earnings. It's earnings upon earnings, or as Albert Einstein reportedly dubbed it, the eighth wonder of the world. Think of it as planting a tiny seed. With time and nurturing, that seed grows into a tree, but the magic doesn't stop there. That tree then produces more seeds, which in turn grow into more trees, and so on. The same principle applies to your investments. A small, consistent investment today can grow exponentially over time due to this compounding effect. It's not about having a lot of money to start with, but about giving your money time to grow. Now, let's delve into the 10 compounding assets you should consider investing in. First on our list is stocks, the king of compounding. When you invest in stocks, you're buying a piece of a company. It's like owning a small slice of that apple pie you've been eyeing in the bakery window. And the best part? As the company grows and prospers, so does your share of the pie. But it's not just about growth. Stocks also provide dividends, a portion of the company's profit distributed to shareholders. These dividends can be reinvested to buy more shares, creating a snowball effect. This is where the true power of compounding comes into play. Think of it as a tree. You plant a seed today, and over time it grows into a mighty oak. With each passing year, it sprouts more branches, leaves, and acorns. This is much like your investment in stocks, which can sprout dividends and capital gains, compounding your returns over time. Investing in stocks can be rewarding, but it requires patience and understanding of the market. Next up is bonds, the steady workhorse of compounding. Now imagine lending your money to a government or corporation, and in return, they pledge to pay you a fixed amount of interest over a set period. That's essentially how bonds work. They're like IOUs, offering you a steady stream of income. What makes bonds a compelling choice for investors is their predictability. You know exactly what you're getting and when you're getting it. There's no guessing game involved. And while the interest rates might seem low compared to other assets, they're consistent. Now, here's where the magic of compounding comes into play. Instead of spending the interest you earn, you reinvest it. Over time, you start earning interest on your interest. This cycle continues and your wealth grows exponentially. It's like a snowball effect. Bonds might not be as glamorous as stocks, but they offer stability and consistent returns. So while they may not make headlines, they're an essential part of a balanced investment portfolio. Third on our list is real estate, the tangible asset that grows with time. Picture this. You purchase a property, perhaps a residential home or a commercial building. Over time, the value of this property naturally increases due to factors such as inflation and demand. This is known as capital appreciation. But that's not all. While you're waiting for your property value to rise, you can lease it out to tenants. This rental income acts as a steady cash flow, padding your pockets while your asset appreciates. The beautiful part? You can reinvest this income into more properties, setting up a cycle of compounding growth. It's like planting a seed that grows into a tree, which then bears fruit. The fruit contains seeds which you can plant again, yielding more trees and more fruit. That's the power of real estate investing. Real estate investing requires more effort than stocks or bonds, but the potential for compounding is significant. Fourth on our list is mutual funds, a diversified way to compound. Now imagine a collective effort where money from multiple investors is pooled together. This is the basic premise of mutual funds. This pooled capital is then invested in a variety of assets such as stocks, bonds, and other securities. One of the key advantages of mutual funds is the potential for compounding returns. As the assets within the fund generate earnings, those earnings are reinvested, leading to further earnings, and thus compounding occurs. This is the proverbial snowball rolling down the hill, gradually growing bigger and bigger over time. But that's not all. Mutual funds also offer the benefit of diversification, spreading the risk across a wide array of investments. Plus, they are managed by professional fund managers who bring their expertise to the table, making investment decisions on your behalf. Mutual funds offer diversification and professional management, making them a great choice for beginners. Halfway through our list, we have ETFs or exchange-traded funds. Now, you might be wondering, what exactly are ETFs? Well, they're a bit like mutual funds and a bit like stocks. Just like mutual funds, ETFs allow you to invest in a wide array of assets, providing you with the opportunity to diversify your portfolio. But here's the twist. They trade on the stock exchange, just like individual stocks. This means you can buy and sell them throughout the trading day at fluctuating prices, unlike mutual funds that only trade at the end of the day. This flexibility can be a game changer for many investors. But remember, along with the potential for higher returns, this also brings in a higher level of risk. So it's essential to do your homework before jumping in. ETFs combine the best of stocks and mutual funds, offering both flexibility and diversification. Next up is REITs, or real estate investment trusts. These unique investment vehicles allow you to dip your toes into the vast ocean of real estate without the need to own physical properties. Imagine owning a slice of the city's skyline, a piece of a bustling shopping mall, or a share in a sprawling industrial park, all from the comfort of your living room. REITs are essentially companies that own, operate, or finance income-generating real estate. When you invest in a REIT, you're buying shares of that company and, by extension, a piece of the real estate it owns. So, how does the magic of compounding come into play? Well, REITs are required by law to distribute at least 90% of their taxable income to shareholders as dividends. These dividends can be reinvested to purchase more shares, leading to a snowball effect of compounding returns. REITs offer a way to invest in real estate with less hassle and more liquidity. Seventh on our list is P2P lending, a modern way to compound returns. This investment avenue is a fresh take on an old concept, lending money. It's just that now, you're not lending to a friend but to a stranger through a digital platform known as peer-to-peer lending. These platforms connect investors directly with borrowers, cutting out traditional financial intermediaries. You, as an investor, can lend your money to individuals or businesses in need of funds. The interest you earn from these loans can compound, growing your investment over time. There's a certain thrill to P2P lending. It's not just about the returns, it's also about being part of someone's dream project, or helping an individual tied over a financial crunch. But remember, with high returns come high risks. The borrower might default on their payment, causing you to lose your investment. So it's always wise to diversify and not put all your eggs in one basket. P2P lending can offer high returns, but it also comes with high risk. Eighth on our list is index funds, a passive way to compound wealth. You see, index funds are a type of mutual fund, or ETF, designed to follow certain preset rules so that the fund can track a specified basket of underlying investments. They're known for mirroring the performance of a specific index, like the S&P 500 or the Dow Jones Industrial Average. Now, why does this matter? Well, by investing in an index fund, you're spreading your investment across the entire index, effectively diversifying your portfolio. This can help limit losses when one or more sectors or companies within the index perform poorly. And here's the cherry on top. The returns from index funds can, over time, compound. This means that the returns you earn from your investment are reinvested, earning you even more returns. This compounding effect can significantly increase your wealth over the long term. Index funds are a great choice for passive investors who believe in the power of the market. Ninth on our list is cryptocurrencies, the new age asset class. Born out of the digital era, cryptocurrencies have revolutionized the financial landscape, presenting an alternative to traditional asset classes. Their rapid rise in popularity is hard to ignore, as they've established themselves as an exciting and dynamic component of a diversified investment portfolio. Cryptocurrencies, such as Bitcoin, Ethereum, and a host of others, are decentralized digital assets that leverage blockchain technology. This means they're not controlled by any government or financial institution. The value of these digital assets can fluctuate wildly, leading to potential high returns and, yes, high risks. But here's where the magic happens. When these digital assets appreciate in value and you reinvest those gains, you're setting the stage for compounding returns. It's the snowball effect in action. Your digital assets could potentially grow exponentially over time, even though the ride may be a roller coaster. Cryptocurrencies are volatile and risky, but they offer the potential for high returns. Last but not least, we have commodities, the timeless assets. Diving into the world of commodities, we find a treasure trove of assets like gold, silver, and oil. These are not just shiny baubles or energy sources. They're powerful tools for protecting your wealth. When the cost of living goes up, commodities often rise in value too, offering a safeguard against inflation. But commodities don't just protect, they can also compound. Here's how. Let's say you invest in gold. As the value of gold rises, your asset's worth increases. If you decide to reinvest the profit back into gold, your investment grows. This is the essence of compounding, earning returns on your returns. It's not just gold or silver. The same principle applies to oil, copper, and other commodities. They can all play a part in a balanced investment strategy, providing a buffer in times of financial upheaval. Commodities are a great way to diversify your portfolio and hedge against market volatility. So there you have it, 10 compounding assets you can start investing in today. We've traversed the rich landscape of investment options, from the traditional stalwarts like stocks and bonds, to the promising avenues of real estate and mutual funds. We've delved into the exciting terrain of ETFs, REITs, and peer-to-peer lending platforms, and explored the burgeoning realm of index funds. We've also dipped our toes into the volatile yet promising world of cryptocurrencies and the solid realm of commodities. Now it's important to remember that diversification is key to managing investment risks and reaping rewards. Spreading your investments across these various assets can help you balance your portfolio and optimize returns. But don't forget the ingredient that truly brings the magic of compounding to life: time. Patience isn't just a virtue, it's an investor's best friend. Remember, the key to compounding is time. So start investing today and let your money work for you.